you're never ever going to predict anything spot on.
Hey, it's Walter here, and you're at the Think Profit podcast, where we're going to help you develop a rock solid trading confidence and avoid the potentially endless cycle of system switching. Right, Hugh?
That's right. We're going to help you develop a wealth mindset, develop a trading strategy that fits your core personality, and help you overcome the obstacles that stop over 90% of traders.
All right, Hugh, sounds good. You ready to go?
Yeah, let's do this.
Hey, Hugh. So I want to introduce a concept I think we've both been thinking a lot about. And this is actually, there was a quote by Williams. What's the guy's name? Williams, the Williams R indicator, the guy who
Larry
won the
Williams.
trading. Yeah, Larry Williams. Yeah. He was saying like the key to trading or something. I don't know, I'm paraphrasing, but he was saying, I think he said this. I'm pretty sure it was Larry Williams. He said the key to trading is finding a trade where you're risking very little, but it can make a lot. And so I think a lot about this in trading is and actually in position sort of like longer term investing as well. Like, how can I set it up so that I am in a situation where I am taking this trade and I've got like limited risk, but I've got like huge potential reward. And how do you set those up? So I call it like an asymmetrical bet. I don't know if that's a normal term. I may have picked it up somewhere, but the idea that, it's not like a system. It's not a thing where it's like, oh, I might lose 10 grand or I might make 10 grand, or I might lose 10 grand or I might make 17 grand. It's more like I could lose 10 grand. Okay. And that would be a bummer, but it can also make like, 27 million. You know what I mean? Like, how do you set that? How do you set those up, and how do you think in terms of that? And I've been thinking a lot about this because it's something I guess as you get older, you sort of diversify your approach to the markets. You're not just trading the same trend following strategy or whatever. You start thinking about different places to put your money and different ways to make it work for you and stuff like that. So what are your thoughts on this idea of the asymmetrical bet?
Yeah, I think I've been thinking about this a lot recently too, and I think that it it can take a little while to get your head around it, right? First of all, you need to look for that. Where do I find an asymmetric bet? Number one, and then number two, how do I take advantage of that? And I've had several cases, like I talked about before. Like I've had that asymmetric bet, but I just cut the profit too short. So I think there's a lot of mindset involved with that, and staying in the bet, staying in the trade, and kind of understanding the underlying structure of the market. And okay, where could this go? How could this? When does this tend to turn around? Stuff like that. And I think ultimately, in my opinion, an asymmetric bet makes trading and investing easier in many ways. I think psychologically it might be less taxing for some people. I know it is for me to maybe risk just a small amount of money to make maybe 10, 20, even more times the original investment. So I haven't really gotten really good strategies around that, maybe in crypto, but in other things, I'm still working out some strategies, like in the stock market. I think there's a lot of advantages in penny stocks. Obviously, you're gonna lose more often than you win, but when those winners hit, then that's going to be a big winner. So I've been listening to stuff like Doug Casey and investors like that who have made their fortunes on asymmetric bets, basically. And I think that crypto is another place where you can really get asymmetric bets if you know what you're doing. So something I'm still working on, but yeah, I really like that idea, and I think it really reduces the amount of work that you have to do, and it also takes off the stress, at least for me. What do you think?
Yeah, I think you're right. I was just thinking about something when you were saying that about like the angel investors, or the what are they called? There's another term for like the companies that will invest in startups. My friend from high school, he works for one of them, but it's like whatever these companies. I'm losing I can't remember the term now. It'll come to me, where they'll invest in new companies or fairly new companies, and they'll get equity, right? And so you can get a lot of information about this thinking from the people who do this. So, like, for example, there's a guy named Naval, and we can put the link in the show notes to this. I would follow him on Twitter. He's a really good follow. Naval. I think it's just Naval, Naval. But anyway, he's known for being like one of these angel investors. And, you know, the penny stock thing that you're saying, that's exactly what they do. All they really do, venture capital. That's right. Venture capital firms. Yeah. So these angel investors or venture capital firms, what they do is they're basically investing in a whole bunch of penny stocks. And they know that a certain percentage are going to gone. They lose the money, everything they gave them gone. The equity that they have in the company is worthless. Some of them are going to do okay, but a few of them are going to be the Twitters and the Facebooks or whatever, right? And that's where they make all their money. And I think, you know, paying attention to what these venture capitalists or these angel investors have to say about identifying opportunities is a really good way to kind of adopt that mindset. And I think Naval is, to me, for me, Naval is one of the most useful, and he has a whole bunch of, like, he had this whole series on how to approach things and wealth and all this stuff, and it's really good, actually. I don't know, people may have even made those tweets into a book, but it's really I think that's one way to approach it, is think of it that way. So if you're going to buy a bunch of penny stocks, it's okay, or even a bunch of cryptos, right? Same thing. You're going to buy a bunch of cryptos that are not, you know, Bitcoin or ETH, and you're thinking, okay, look, I know some of these are going to, you know, not shake out, but a few of them hopefully will, and that will make all the difference. But you spoke to the point there, which is you never make money until you exit your position, but you also lose the potential to make more money if you exit all of your position, right? So, so what I've always ended up doing is I've done the foot in both, you know, camps sort of thing, where I will exit some and then hold on to some in the hopes that it'll keep going, right? That's the only thing that I've been able to figure out that can cycle a lot until someone shows me something better. That's the only thing I'm able to do, is to kind of scale out, right? So get out at where I think is a fair price, and then also hold on to it, you know, maybe, you know, have a break even or sort of, you know, bottom line thing. If it goes down here, I'm out, right? But with that remaining position, I'm going to hold on to it as long as I can and try and ride the wave, right? Because that way you always feel good about yourself. Like if it only goes to about your target, maybe a little bit further, and then falls, and you lose out on the second half of your position, doesn't do that well, at least I, you know, half of it made it. And the other case, where if it actually goes, assuming that this is a profitable, you know, trade or whatever, or position, you do really well, because the remaining half bags even more profit. So, you know, either way, you're kind of feeling good about yourself in some ways, as long as you at least hit that target, right? Yeah. So I think adopting like an angel investor mindset is maybe one way to do it. And it's almost like, I'm thinking of this almost not like trading, more like investing, you know, more like a long-term thing where you're just going to sit on it. Like, and if you go back and look at the markets, there are a lot of instances where if you just bought near the bottom, now I know it's really hard to know when you're at the bottom, but if you just bought near the bottom and held on, that's really all you need to do. Because like if you look at things like the NASDAQ or whatever, or you know, the S&P, there will be like 10 years where it's basically range bound, right? And certainly currencies are exactly the same. Like if you were just able to get in, and I know this is really hard to say, it's really hard to say, you know, just got to buy the bottom or sell the top, right? Yeah, that's tough, right? I understand that. But it's this thinking of being contrarian. And that's, I think, the take-home message here, is that the angel investors, they're thinking in a sort of contrarian way. Like everybody's looking for the new Twitter. Well, you know, I'm looking for the new TikTok or Facebook, or you know what I mean, or whatever. You know, it's something everyone's trying to beat Uber by being a better Uber. Well, you know, what about this company that's working on, you know, drone delivery or whatever? You know, I don't know. Like there's something else that's beyond that. And also your approach, if you can adopt a contrarian mindset, then you can use things like the Economist, that magazine. Use the cover of The Economist as a contrarian indicator. That is a great one. Or, you know, any of the business papers like USA Today, or like, is it not a business one, but the Financial Times in London, or the
Jim Cramer.
the wall. Yeah, Jim Cramer. Yeah, exactly. That's really, yeah, that's exactly it. Like I'm not going to name any names, but there are some people in the cryptoverse who do videos on YouTube consistently, and I use them as a contrarian indicator, right? So as we record this right now, they're saying that that they believe the bottom is in on Bitcoin. Okay, so Bitcoin went down to, I don't know, 17,000 or something like that. And now it's up at 23 today as we record this. Okay, so it's made a $6,000 move up. And they're saying that they think the bottom is probably in and it's going to go now. So I'm thinking the opposite, right? I'm thinking this is a bull trap. It's going to go maybe it goes 25, maybe it goes 27,000, and then it's going to fall and take out the floor. So you know what I mean? It's kind of thinking like that in many ways, and learning from the angel investors and the venture capitalists. I think that's the way to do it if you're looking for these asymmetrical bets. That's my idea anyway.
Yeah, totally. I think that, at least I found that, the scaling is super important. Like, you're never ever going to predict anything spot on. So you just take your best guess. You take a position, you take a part of your position, you take some profit, or you scale in, and then you say, okay, on this move, I'm going to go for between 2 to 5 entries or exits, and then just stick with that. And then when it comes down, you take a buy. It comes down again, you take your next buy, and then they might move up or whatever, but at least you won't lose that or miss out on that move. So I think that's a key point to highlight.
Yeah, that's great. That's a great point. I learned that from a trading mentor. He really liked threes, so he would do it. He would put it in sixths. So he would do exactly what you said, and it's a really good point. If you're going to do this long-term sort of position trading, sort of asymmetrical bet stuff, yeah, he would go, okay, my first sixth, I'm going to drop it here. If it goes lower, I'm going to go in again with my, you know what I mean? And he would just ride it out. And I always thought, though, like, I understand that, like keeping your powder or whatever, like keeping more bullets to shoot the target or whatever. But I always thought, like, to me, when he first taught me that, it was hard because I was like, well, what if it just goes to your first, like, floor and you buy a sixth and then it just goes? 5/6 of your position wasn't locked in. I was like, oh, that's kind of a bummer. But I guess you just keep waiting. Like you have like this long-term view, and eventually, it'll collapse again and come back down to your levels, I guess. I don't know. I just thought that was interesting. But you're right, because what you say is so important, because what will blow you apart as a trader and ruin all of your investment capital, in my opinion, right? This is not investment advice, right? It's my opinion, is that you would actually go really hard, where you think you've hit the floor, you go in fully, and then it falls another 50%. Now you're in trouble, right? So that's why the old guys will tell you, divide it up into however many pieces. My mentor said 6, because he liked everything in threes for whatever reason. I don't know if he was a GAN something or whatever, but like he liked the threes. And then that was it. He would just go boom, boom, boom. And then once it goes 6 levels, you're fully loaded, you're in, and you're not going to, like, there's nothing else to do, and just wait. You could still lose, but at least you didn't go all in at a certain level. And that way, you're not hurting. So the scaling in and scaling out thing is really important. And I think you'll see that in a lot of interviews. If you go to a lot of trader interviews, you'll hear that pretty consistently, I think.
Yeah, especially with like the hedge fund managers and stuff with a longer outlook.
That's right.
Okay, cool. Yeah. Thanks, Walter.
Thanks.
See ya.
All information in this podcast is for educational and informational purposes only and is not trading or investment advice.